Let's talk about that now with Jeff Sherman. He is Deputy CIO over at DoubleLine Capital. Joining us on set, Jeff, it is great to see you. And let's talk about the bond market. We'll just start with the price action because it has been incredible. You look at 10-year Treasury yields up something close to 80 basis points in the last 3 months. What's driving that? What's going on here?
Well, the narrative has shifted. At least that's been the explanation for the movement we've seen. I'd say 2-3 months ago, no one cared about deficits. I mean, yeah, people talked about it. All of a sudden, we talk about this newfound U.S. resurgence in growth, that the U.S. is infallible, and that narrative has really caught hold. If you look at it, I mean, we've had that reversal over 2 months, but like 60 of it's been the last 1 month. And so it just seems with the dysfunction in Congress, this is now at the highlights. But ultimately, there still is value in treasuries, and Eric talks about the cash burn in that trade, but that trade will work. It's just in the short term, you know, things go against you for a while. But the momentum's been horrific. There's this idea that the yield curve is going to steepen to teach Congress a lesson, and that ultimately that's going to bring them to their senses about deficit spending. But as we saw, we have another 6-week extension. Nothing's changed over the course of the weekend. And so ultimately, now there's just better yield out there. And I think that's what you're seeing in some of these models that Eric brings out, as well as investors' preferences right now. I think Eric said it too at the top of the set here, was that ultimately people are playing for a recession. And so, you know, we know that third quarter GDP is going to be very strong, right? But remember, GDP is one of the most backward-looking indicators, right? And so even going to the last recession we had, and I'll call it the 08 recession, GDP was still almost 2.5% in that last quarter. So the idea that the U.S. economy is going to continue to fire at this 3-handle rate, I think that's what consensus is for the third quarter. It's just not tenable at this stage. We've seen excess savings decrease. We know student loan payments are there. And let's not forget about the big elephant in the room, and that is significantly higher oil prices right now. And so these things inherently are going to be some drag on the consumer. And so it doesn't mean that just because we have a slowdown, it has to be recessionary. But yields do look a bit high, especially on real yields at this stage for where we are in the cycle.
So what is your outlook for a recession? Because last time you were on with us back in June, you said a recession was in the cards over the next 12 months. But as you mentioned, since then we've seen oil go from what, about $70 a barrel to $90 a barrel. We got the UAW strike, which according to Bloomberg economists could shave off a full percentage point on GDP in the fourth quarter. What's your view on when or if there's going to be a recession?
Yeah, it still looks like it's going to be something in the middle of next year, middle to late of next year. And again, these are hard to nail the exact timing of it. And just because we've had good economic data doesn't mean that you should be on reprieve at this point. You mentioned all the reasons that recession risk should be rising, not falling at this stage. And so, again, the strikes are not a good thing. Oil prices being higher is not because there's this massive demand. It's a supply side part of the equation. And I noticed I filled up my car with gasoline, unfortunately in California, one of the highest places for gasoline, and we're back almost to price that we had with the Ukraine invasion.
You don't have an EV?
I do not have an EV at this stage in the cycle. Like, we do have a hybrid type of thing.
Everyone in California has EVs.
Yeah, but the hybrid makes more sense until they have all the infrastructure. I just can't wait an hour at the place. I mean, look, time is money. We all say that. But ultimately, there are better ways to do it, too. You can electrify your house and those as well. But that being said, I think what we have right now is really a setup for the slowdown in the consumer. And again, this doesn't mean that we need to fall down, that the recession needs to happen, the consumer is going to fall apart. But what it does connote to me is this entire move that we've seen has been real yields. This is not because of a higher inflation environment. It's this extrapolation from this good data we've seen over the last 6 to 8 weeks.
When I see all the money lost this year, you see this every 3 years. A trade is just so attractive and it just never works. I do think of laddering. You know, laddering is sort of a Fred-proof way to make your portfolio. You don't have to worry about the recession or the Fed. Is there a case against laddering, which is, again, to go 10 years out each year and then, sell the one and then buy the next year out? Is there any reason not to do something like that when it's so hard to pick it?
Yeah, no, I mean, look, picking bottoms in any market or tops in any market is notoriously difficult, and it's hard to get right more than once or twice in a career, let alone be persistently correct. And so I still don't think there's anything wrong with it. I get the pushback from clients is, why don't I just ladder a bunch of T-bills, roll 6 months and then roll that from one, because that trade has not lost money too. And so the front of the curve is attractive, but what I remind folks is that it has risk, and it's not risk of the government default, it's risk of reinvestment as well. And so I think what you're finding is that people see this, they see the real yield out there, they don't believe that we're going to be in this higher inflation environment that is a a 3, 4, 5% inflation environment the longer term. And so there is value in locking some of that in. The biggest risk to this is the deficits, right? And so over the short term and the nearer term, we do think that that trade does make a lot of sense. Do I want to own it for 30 years? Absolutely not, right at this stage, just given how dysfunctional things are out there. So from the standpoint of trying to ladder or invest, I mean, it's exactly what we talked about last time on the show, is that it's not just about rates, it's also about credit too. And since then, credit has worked, right? And so putting those two trades together still makes sense in today's environment. And by the way, we're now at cycle highs, right? 5s, 10s, 30s, as of today, are at new highs in this cycle. And so for those that have been patient and sitting in some of those trades on the front of the curve, rolling T-bills, sitting in cash, it is the time to start moving outward a little bit. And if you're scared about it, start at the 5-year part of the curve, right? You don't have to go all in at the 30.
All right, Jeff, we have to take a break right now, but you'll be sticking with us, and we're going to talk much more about the credit market next. This is ETF IQ on Bloomberg.
Back to DoubleLine Deputy CIO Jeff Sherman, who joins us here at Bloomberg headquarters. So, Jeff, as Katie just mentioned, the outperformance of junk bonds is something we're certainly watching, but why has it been so unloved?
Well, I think what you have is you have duration again, right? And it's just that sensitivity there. And, you know, people have been playing the recovery in junk bonds throughout the year, right? Junk bonds have done well, 5%, you know, when you juxtapose that against what we see in the rates market. But some of the challenges with the floating rates is that these are the credits that are most at risk in this type of environment. And what I mean by that, if you think about the Fed's hiking regime, this 525 basis points they've delivered to us over the last 18 months, it is evident within the floating rate market, right? These borrowers have to pay north of 5% more than they were 18 months ago because of the coupon reset. So these are the most at-risk issuers to Fed policy today. Now, some of them have bridged the market and went to the high yield market as well. But you've seen weakness in high yield as of late as well. But spreads are kind of tight-ish in that market, and you've actually seen some refi activity within the high yield market over the course of the summer before this last push up in yields, where people are trying to get ahead of the maturity walls that are coming next year. So I think what you're seeing is that people are fearful of a slowdown. I think if you look at the flows to me say that people are trying to counter trade this market, right? They're selling the stuff that's done well. They're trying to buy things that look a bit cheaper on there. We do think that the Fed stays higher for longer. As the mantra's been for a long time. We never believed in the rate cuts this year type of argument. But ultimately, that is where the most credit exposed risk is. So if you think about these parts, and I don't want to get too wonky on tranching and all the losses, but if you have a significant default experience within the loan market, remember that was just my concern talking about bank loans over high yield, and you have lower recovery rates than you've seen in the past, I don't think the BBB tranches themselves are at risk for principal impairment, but the ones right below that are at risk for taking pretty severe principal losses. And so again, it's just understand the nuance there. I know I've got a lot of people on the street that are going to ping me later on today and say, Jeff, why are you out there bashing, you know, BBB CLOs? And I'm not doing that, but I think it's just not really understood by the marketplace, and it's really more of a professional type of area to invest in. If you look within that mortgage-backed securities, it's split to pretty evenly between the agency mortgage market as well as the non-government guaranteed, or we call the RMBS market. And the RMBS market has been stellar this year. It has significantly less duration than even the high yield market. It has a little less yield, obviously, than the high yield market, but you can buy high quality bonds in that space that have 7-handle yields today. You look at the agency mortgage market, and to Eric's point of people looking for a trade that got cheap and just hasn't done anything, look none other than the agency mortgage market. Spreads there are some of the widest we've seen in 15 years because, again, a lot of the bank demand stepped away with some of the banking problems we had earlier in the year, but also just there hasn't been this flock back to it, that part of the market. And so the reason that there's that significant exposure to that segment of the marketplace today is, one, we can get a government guaranteed asset or a government backed asset that has significant yield pickup to treasuries, right? It behaves like treasuries in a risk off environment, and we don't have to worry significantly about a lot of the prepayments in there because of where the coupon stack is. And so in general, we find that those parts of the market are very interesting to us today, and they have yield pickup to other parts of the market with different risk profiles.
Jeff, I've got a producer in my ear. We got to go. But in 10 seconds or less, credit risk or duration risk right now, which are you more comfortable taking?
Given the sell-off, I like duration risk a little bit better today. I still like the credit we own. You can hear it. You can see it from the portfolio, the way they're positioned. But I like the duration risk given the sell-off and where yields are today.
I think that was 12 seconds, but that was pretty good. Jeff, it's great to see you, as always. Jeff Sherman, Deputy CIO over at DoubleLine. Thank you so much.